I looked at the battery sector 2 to 3 years ago, and I couldn't find really anything on it that pulled everything together. So that's why I started Battery Materials Review. It's like a one-stop shop for everything you need to know on the battery sector, from the upstream into the midstream down to the downstream, what demand trends are looking like, what supply trends are looking like, what companies are doing what where, and what materials are in vogue at that moment and why they're in vogue.
My next guest is Matt Fernley. He's the managing editor of Battery Materials Review at batterymaterialsreview.com. Matt, welcome.
Thanks very much. Great to be here.
Matt, it must be a great time to be the editor of a publication called Battery Materials Review, in that markets are crumbling, yet battery materials are still rising in price, and the companies that produce them and use them are also sort of enjoying a sweet spot currently. Give us an overview of what does Battery Materials Review really focus on and cover, and how do subscribers find it?
Well, I will say it's fun now. It's been a difficult time though over the last 2 to 3 years leading up to this, so I'll take any joy when I can. Basically, I am an equity analyst on the sell side and on the buy side, and I looked at the battery sector 2 to 3 years ago, and I couldn't find really anything on it that pulled everything together. So that's why I started Battery Materials Review. It's like a one-stop shop for everything you need to know on the battery sector, from the upstream into the midstream down to the downstream, what demand trends are looking like, what supply trends are looking like, what companies are doing what where, and what materials are in vogue at that moment and why they're in vogue. So really it's aimed as a sort of one-stop shop for people to learn about the battery materials sector, but also to find out about what the drivers are at any one time.
One of your more recent articles actually focuses on the burgeoning new battery production planned for North America by the likes of CATL and LG, among others.
Yeah.
So I'm sort of interested in focusing on that a bit, because it's like, are these guys going to build batteries for the incumbent auto manufacturers? Are they going to build batteries for the emerging breed of new electric vehicles? Or is it going to be all of the above? And is there no North American competitor who's going to sort of take issue with the fact that they're setting up such big production facilities on North American turf?
It's kind of all of the above. So obviously, I mean, if you look at the breakdown of electric vehicle sales sort of globally at the moment, it's dominated by China and Europe, and the US market is a relatively small market, which is obviously dominated by Tesla with over a 50% market share here. If you look at the cell manufacturing, basically 100% or certainly over 90% of cell manufacturing in North America is carried out by Panasonic for Tesla. And what we're talking about here is a situation where all of the incumbent automakers, the OEMs like GM and Ford, and the European automakers and Japanese automakers with North American businesses, need to build out their EV supply chains, which involves building EV factories, and that involves building cell factories, and as importantly, building out the midstream and upstream supply assets for those operations. So at the moment, the major operator is Panasonic. They've been pretty staid in terms of their battery expansions over the last 2 to 3 years. And in fact, most of the Korean and Chinese producers have sort of leapfrogged them in terms of becoming the largest producers in the world. And in fact, that's what we see in North America. It's the outward-looking Korean manufacturers like LG Energy Solutions and Samsung SDI and SK Innovation, who are opening up operations into this market, have formed joint ventures with Ford and GM and other players in the market. But, I've said for a long time, North America has got all of the advantages in terms of its sort of raw material supply base. Canada in particular is in a great spot. Canada's got most of the key battery raw materials. It's got lithium, it's got cobalt, it's got manganese, we hope, it's got nickel, it's got graphite. And on top of that, it's got something which is really, really important to the battery industry at the moment, which is hydroelectric power. And, cathode manufacturing, anode manufacturing can be quite a power-intensive process. So having hydroelectric clean power has the potential to make the battery industry that much more environmentally friendly than it is at the moment, whereby you dig the stuff up in Australia, you ship it to China for processing using very dirty power, and then you sort of move it out elsewhere around the world for further processing. So, there's a huge opportunity for North America out of the EV story, and we're starting to see the groundwork being laid now. And it's very interesting to note that, the early movers on this were the Europeans, who were talking a very good story about integrating and backward integrating their supply chain. They've spent the last 3 years talking, and the North Americans have spent the last year or 2 years starting to take action. And they are now in a position, I think, to leapfrog Europe in terms of building out a viable EV supply chain going forward.
One of the most pressing issues on the ingredient side for EV batteries is obviously the divergent supply-demand lines in the lithium supply. And so, I guess it obviously is important that lithium is available to would-be battery manufacturers. But I'm curious as to what extent does the divergence in the futures market lithium price at roughly $85,000 per ton versus the actual contract delivered price to battery manufacturers today of, call it $20,000 to $30,000 per ton. How is that reconciled to the future price growth that the actual manufacturers are going to pay? That's the first part of my question. The second part isn't lithium shortage relative to demand going to catalyze alternative battery chemistries that don't involve lithium?
So just to start off with on the lithium prices, there's a real juxtaposition in the market between the spot price, which you said is around about $70 a kilogram now, and the contract price. Now, the lithium market is going through quite significant changes, and in many ways, what's happening in the lithium market is quite similar to what happened in the iron ore and coal markets during the China commodity supercycle 10 or 15 years ago. And that was a market that went from trading on annual contracts, sometimes multi-year contracts, to a quarterly and spot market. And it took probably 2 to 3 years before prices fully transitioned over from long-term contracts to shorter-term contracts. And that's effectively what's happening in the lithium market at the moment. So the brine producers out of Latin America, which is the traditional source of lithium, they are primarily using longer-term pricing and volume contracts, whereas the new boys on the block, the Australian hard rock producers, are using shorter-term pricing contracts, but still longer-term volume contracts. And those pricing contracts are slightly backward-looking insofar as they look at the last quarter's price increases, but they're much more closely linked to the spot price than the annual price contracts and multi-year price contracts that you're seeing out of Latin America. Now, over the course of this quarter, some of the Latin American brine producers have moved more over to a quarterly pricing mechanism, but some of them have still locked into legacy contracts with cell producers in mostly Korea and Japan. And as a result, the realized prices you're seeing from some of the Latin American brine producers are closer to sort of $20 to $30 a kilogram rather than the current spot price, which is around $70 a kilogram. So that's the situation on prices. And over time, you'll see that the longer term components of that will become a much smaller percentage of the industry. So I would expect the industry to converge towards spot prices or last quarter spot prices over time And, a lot of producers are, particularly in Western Australia, who are starting up production now, are moving to, a large percentage of their production, or a reasonable percentage of their production, directly exposed to the spot price. The second part of your question was on structural supply and demand, if I'm correct, and this is a really difficult one. If we were in a bog standard commodities market and prices went up 10 times as they have done in the lithium space, we would be seeing demand destruction for certain. We would see demand destruction. In this market, we're not really seeing that to the same extent. And the reason that we're not really seeing that, in my view, is because electric vehicle sales are not directly driven by the consumer. They're driven by governments. So particularly in the EU, to some extent in China, EV sales are subsidized by national governments. And as a result of that, we're not sort of seeing the demand destruction that you would expect to see as the higher raw material prices filter through the supply chain. In some areas, we have seen third and fourth tier battery producers, cell producers, raise prices at the end of last year. That's filtered into EV producers. In fact, I've just written about that in this month's issue of Battery Materials Review, and we have seen 4 or 5 EV producers globally and 15 or 20 of them in China raising EV prices. But you see, the problem with EV prices, if you look at the median EV price, it's probably about 30,000 euros per vehicle, whereas the median price for internal combustion engine vehicles, I'm talking in Europe here, is about $15,000. So EV prices are not really in mass market at the moment. And as a result of that, there is less price elasticity there's less demand elasticity to price. Having said that, the other issue that we're dealing with in this industry is a huge shortage of supply. And, we expect prices to remain at elevated levels going forward. And actually, at the beginning of this year, I actually introduced a second EV sales forecast, which is an unconstrained EV sales forecast. And I've taken down my EV sales forecast to deal with the material constraint, primarily lithium, but also graphite and some of the other battery raw materials. And, by 2025, my constrained EV sales forecast is about 19 million units a year. And my unconstrained EV sales forecast is about 40 million units a year. So the auto manufacturers are actually going to be giving up around about 50% of the sales that they could have been doing, because there's just so much of a supply constraint. And this sort of rounds out our views on the equities, and on the producers, because there's so much of a supply constraint. It's going to be a very, very tight market for 5, 6, 7 years with regards to sort of lithium supplies, but also other battery raw materials.
Have you seen any alternative battery chemistries that don't involve lithium that have a realistic chance of becoming a significant disruptor to that anytime soon?
Yeah, this is a question we get a lot. The answer to that is not really in electric vehicles. So the next technology that's supposedly around the corner, been around the corner for about 5 years, is solid state, which involves replacing the anode with solid lithium metal. Now, that's not so great because the shortage here is in lithium, and lithium metal is obviously very expensive. So I don't really see solid state becoming a big mover and shaker in the industry until probably the mid-2030s, maybe later than that. On the energy storage side, or on the stationary storage side, there are competing technologies. So things like vanadium redox flow batteries, chromium, zinc, iron flow batteries are different chemistries to lithium ion. and they could take off in my view, and probably should, because they offer a slightly different offering to lithium ion. Lithium ion is what we call a very short duration product. It has once the energy bleeds out of the batteries, it lasts for about maybe 2 hours, 1.5 to 2 hours, whereas some of these long duration technologies that will last for 12, 18, 24 hours. And that's relevant if you're putting your batteries together with, for instance, a wind or a solar plant, because if I'm running a solar plant, I charge up my batteries during the day, and then they can basically discharge over the whole night and provide a steady state supply. So having a long duration battery in that situation is very, very much positive. So these other technologies are there, but they're just waiting for that sort of gigafactory moment, if you will, when somebody says, look, here's $1 billion, I'm going to build a gigawatt-sized factory, and we'll take that forward. But there are, a number of early stage companies that are looking to commercialize these techs. And in fact, vanadium redox flow batteries, VRFBs we call them, have actually been around since 2015. We're hopeful that some, if not all of these techs can take off. Going forward, I think that they won't totally replace lithium ion in ESS solutions, but it would be nice to see sort of like a hybrid solution where you can take some of the weight of demand off the lithium ion space and replace it with other materials.
Mm-hmm. Okay, great, Matt. We're going to leave it there for now because we're out of time. I really appreciate your contribution. Thanks for joining me today.
Pleasure. Thanks very much indeed.